My guest today on Raising Private Money has already raised $20 million in private money. Well, he didn't start out in this world of private money. He actually started his real estate career as a realtor, where he was selling single family homes. Actually, he started out in the third most competitive market in the entire country. Well, he was so good at his skill, he was actually able to become a top producer within the second year, and this was at the largest firm in the area. Well, my guest quickly discovered that as a realtor, you're sort of pretty much working for tips, right? It's all transactional. So he woke up and he realized that there is a difference between being rich and being wealthy. So what did he do? My guest started to look for ways to turn his high transactional income into what really matters for the long term. And what is that? Long-term wealth. So he could actually buy back his time and not be trading hours for income, but actually investing for the long term. Well, when he learned about apartment syndications, everything changed. Why did it change? Well, apartment syndications actually provided a truly passive form of real estate investing. Today, he's a passive investor. He's raised millions in private money for apartment syndications. And so his passion today is to share his knowledge in apartment syndications and how that can change your life as well. Well, you're going to meet my guest, Mr. Justin Moy, in just a moment, right after this.
If you're a real estate investor and are wondering how to raise and leverage private money to make more profit on every deal, then you're in the right place. On Raising Private Money, we'll speak with new and seasoned investors to dissect their deals and extract the best tips and strategies to help you get the money, because the money comes first. Now here's your host, Jay Connor.
Well, first of all, Justin, let's be very clear so everybody knows what we're talking about. What is an apartment syndication?
Yeah, absolutely, Jay. So an apartment syndication is a phenomenal way to grow and scale an investment portfolio and to bring in investors who are not in the day-to-day of real estate in their personal lives and give them passive opportunities to get into some of these assets. So a syndication is we're essentially buying a big property, and instead of coming up with a 25% down payment and 5-10% closing costs and millions of dollars up front from ourselves, we pull in investors and we raise that money, $25,000-$50,000 at a time in exchange for equity. So it's a great way for an active investor to grow and scale their portfolio. And it's a fantastic way for people who don't want to commit the time or energy to learning about real estate and to really be active in this game to have truly passive opportunities in this space.
Awesome. So I call someone like you, like myself, you're the orchestra director, right?
Yeah, great way to put it.
You're pulling all the investors together. You're negotiating the deal. You're putting the deal together. You're raising the money. Mm-hmm. And so, as you say, syndication is a totally passive way that an individual can get involved in real estate investing, but they don't have to go negotiate the deal, create the deal. They can simply just sit back and, invest and get returns. So really, we have here on my podcast two different audiences for you to speak to. You got one audience, which we have a large audience of real estate investors. Some are very, very seasoned. Some are brand new, looking at their first deal. And then we have another large part of our audience, which are people like you look forward to invest in your syndication deals that are very interested in real estate, but they want to be totally passive. Yeah. Let's first speak to our audience, the part of our audience that is interested in investing in being a real estate investor, not passively, but actually raising the money, right? Yep. And then let's speak to the other part of our audience of someone that's just interested in being totally passive and how that works. So
Yeah, perfect.
my first question on raising private money. So for someone that has never raised private money before, and you've raised 20 million and still raising it. So you've raised a lot of private money. What is like your biggest lesson learned or a mistake that you've made in trying to raise or in raising private money before that you would not do again and advise someone new that's raising private money?
Yeah, I think so much of that that learning curve happens on that first time. It's a very, very, very common thing that when you're raising for that very first deal, you simply overshoot and overcommit what your true capabilities are. So, a lot of times when we're talking about real estate investing, and, I always like to say everybody wants to be a real estate investor. So if you go to your friends and family and your coworkers and everything, and you say, hey, I'm doing this really cool thing. I'm raising money for deals. You're going to be a passive investor and we're going to raise for these types of deals. And the returns are this. Everybody says, that sounds so cool. Let me know the first time you have a deal, we're in. And those are the famous words, yeah, we're definitely in. Let me know. And then when that first deal comes around, a lot of those people start to fall off because now it's showtime. And so, before, if you're doing tallies in your head and, okay, I have 10 people who each said they'd willing to give me, 50 grand, I have $500,000 to raise, now you can only come to the table with maybe 100,000, maybe even less. So really, really narrow in exactly how much you think you can raise, and don't be afraid to put not fake deals, but preemptive deals in front of your prospective investors to see who is really still gung-ho when real deals come around, instead of just saying a verbal commitment saying, yes, when you have a deal, that sounds great. Let me know. I'm definitely interested in investing. So that's the big one that I see a lot of people do, is they really take that verbal commitment very seriously. And then when it comes time to pull the trigger and wire some money, they're left with a lot less than they thought they could do initially.
Yeah, along those lines, that's why I have learned. I've been raising private money since 2009 for single family house deals. It's all the same money, whether you're doing apartments or you're doing single family houses, all the same private money, just structure the deals differently. But one big lesson I've learned is when I have a new private lender that says they want to invest, I better be able to put that money to work pretty quickly, because I've learned the hard way that private money is sort of like bananas. If you don't consume it pretty quickly, it's going to like go to rot on you and disappear. So, you need to put that money to work. Another thing too is it's for me, Justin, tell me what you think. Raising private money is so much to, of course, you got to know your program, what you're offering, how, being able to explain how your investors or your private money lenders are protected. But so much of it for me has to do with mindset. And what I mean by that is I had to get out of my head. I'm not begging, I'm not chasing, I'm not selling, I'm not trying to persuade. I'm actually teaching people what private money is, how they can actually invest and so my wife, Carol Joy, and I, right now, we've got 47 private lenders that are investing in our deals, funding our deals. And you know what, Justin? Not one of them had ever even heard of private money and private lending. They didn't know what it was. Mm-hmm. So here I am with this mindset of being a teacher, and I started teaching people what private money is and how they're protected and how my program works. And Justin, I tell you one big lesson I learned at the very beginning of raising private money is the worst time in the world to be trying to raise private money is when you need it.
Yep. Yeah. Pipeline management is huge. It's huge in this space. You have to always be talking about what you're doing. You have to stay really active and stay in front of those prospective investors. And then if you get into that hump, it's exactly like you said, it's an educational platform. You have to go at it from a mindset of education, and you have to truly, truly, truly love and believe with 1,000% of your heart and your soul that what you're doing and the deals that you're working on are phenomenal deals. If you doubt even a fraction of a percent, people can tell. You're going to act differently. You're going to give off some signs. You're going to be a little bit nervous. And we've heard this many times that all decisions are made emotionally and justified logically. So even if your investors don't know why they're saying no, they won't even be able to explain it, because even if logically the deals make sense and like and trust each other, but there's just a little bit of something there that you're not portraying or that you're hiding a little bit of, they're going to be able to tell, and you're going to start getting a lot of no's. So totally agree with everything you're saying. You have to be educational, and you have to truly, with all your heart and soul, believe in everything that you're doing.
And along those lines, Justin, I tell you, if I don't believe in myself and if I don't have confidence in myself, who else is going to?
Yeah, exactly. Exactly. And people can tell, people can pick up on these things. It's just like if you meet somebody for the first time and you walk away from the conversation, you go, I don't know. I just, for some reason, it doesn't have to be about business. It could be about anything. You could meet a friend of a friend and you just walk away and you go, I don't know. I just didn't really like that guy or girl. It's not a logical thing. It's an emotional thing. You just so happen to pick up on something that they were giving off or something that they said or a way that they looked, and your body's picking up on it. So yes, your investors, they will definitely be able to tell. You got to have the confidence in yourself, and you've got to have the confidence in your product.
When it comes to teaching potential private lenders what private money and private lending is, another big lesson I've learned, Justin, is if you want to raise a lot of private money for your real estate deals, you better know what self-directed IRA accounts are and how people can transfer retirement money over to a self-directed IRA third-party custodian and lend that money out. The reason that became so important to me is because over half of our 47 private lenders are using their retirement funds to invest in our deals. And if I didn't have a relationship with a self-directed IRA company, my relationship is with Quest Trust out of Houston, Texas. When I'm teaching somebody about private money and going to raise money, if I don't have that relationship in place with a self-directed IRA company, I'm going to miss out on over half of my funding from people that don't know what this world is about. And I need to be able to introduce them, so if they're not happy with their retirement funds and the rate of return that they're getting wherever they have them invested, then I need to be able to, introduce them to who I recommend as a self-directed IRA company. You agree with that?
Yeah, absolutely. And so many people do that because before you step into the world of private money, that's what you're taught. You're taught, put your money in these, put them in the 401k, in the stock market, in your IRAs. And those aren't bad strategies necessarily, but it's what everybody grows up thinking. So they get a job. That's the first thing they start doing. It's, the 6% of every check goes in there, the 10% of every check with the matches, and they start stuffing their money in here. And then by the time they start getting more educated and more comfortable with alternative investments and private money, they're looking at this saying, oh my goodness, I have, hundreds of thousands, maybe even more stuffed away in these accounts. How can I use those? So yes, you got to be up to date with what's going on legal wise with different accounts, how different people can invest in different strategies, and stay educated on what's going on with those retirement funds and those accounts from a market perspective. What are average returns looking like? How has the last couple months impacted what their true returns are? How can they look at how their portfolio has actually performed over its lifetime? So you can speak to these things and appear very educated on the topic. Not appear, you should be educated, but you gotta be educated to appear educated on it. So again, taking that educator platform and just telling them exactly what it is and why you're doing what you're doing and why some people like the private money route. And then that's it. It's up to them to make the decision on if that's best for their lifestyle and their portfolio. But you got to be sharp with your education on these topics to truly inform them.
Justin, I've got a gift that I want to give away to our audience, those in the audience that are watching or listening that are interested in raising private money for their real estate deals. And that is, I'm so excited. I recently finished writing my new private money guide, which is called 7 Reasons Why Private Money Will Skyrocket Your Real Estate Business and Help You Build Incredible Wealth. You can download this private money guide for free at jayconner.com, JAYCONNER.com/money guide. Again, that's jayconner.com, JAYCONNER.com money guide to get you on the fast track to raising private money for your deals. Justin, let's change gears now and let's speak to those that might be interested in being a totally passive investor, a private lender investor without having to find deals, negotiate deals, oversee deals, and just get really, really attractive rates of return totally passively. Well, as you alluded to a moment ago, people grow up, they start in corporate America, they start doing the 401k, and they're investing in the stock market. And I have so many people come to me, particularly within the past year, totally fed up, sick and tired with the volatility of the stock market. So let me just ask you this question, why can't people really rely on the stock market anymore as a long-term wealth builder, in contrast to considering syndication?
Yeah, I love the question because what a lot of people don't realize, in my opinion, is why the stock market is actually the quote unquote conventional means of investing. The reason why is because earlier on in the century, it was the big winner. It was the big winner. If you look at the 80s and the 90s, particularly with the stock market, there were 20 years within there. I think there were 16 years or 15 years of those 20 where the stock market posted double-digit gains. Double-digit gains. I think it was 15 out of the 20 years. And it only lost, I think, 1 or 2 of those years. And since the 90s, it has just been extremely volatile if you're looking at indexes. Now, part of the reason why that is because of the companies that make up things like the S&P 500, where we're now switching to more volatile tech companies as opposed to more stable, manufacturing companies in the past. So the volatility has really, really kicked up. And what people don't realize is with the stock market, even if you've been investing in indexes since the 60s on a consistent basis, your average rate of return is between 6 and 8%, not including inflation, not including taxes, not including if you have anybody managing your portfolio for fees. So I think a lot of people, when they realize that and they take a step back and look at their portfolio on the public sector, they're going to be extraordinarily surprised that their money wasn't really working as hard as it could be in terms of private money investments where we're seeing high double-digit returns on a pretty consistent and conservative basis. So the public markets, they used to be slam dunk home runs almost all the time, but those times have really changed, and we're seeing the average returns really get impacted negatively by that.
Justin, let me give you an example of the stock market not performing. My mother, who is 88 years old, I get a copy in the mail of her stock market investments. They've only dropped 22% in value in the past 90 days. Right? So, my wife, Carol Joy, and I, we get thank you notes in the mail as to how we have changed our retirement years.
Yeah.
From our private lenders, right?
Yep.
Speaking of the risk, so obviously there's big time risk in the stock market. What are the biggest risks in investing in syndication?
Yeah. And I would love to do that. And just to step back one moment, like you said, you're looking at your mother's portfolio. My mother actually couldn't retire. She had to put off retirement for another couple of years because her portfolio, she was really depending on that. And then of course times hit us hard and now she had to push that back. So I totally agree. It's really starting to impact a lot of people. And when you talk about the risk of private versus public investments, in the private sector, specifically with syndications, is you really are making a passive investment in an operator. So we're operators. Operators are kind of the active partners in the deal. That's where a ton of your work comes into play, because once you make the investment, you are truly passive. So you're truly passive. There is zero time, energy, or knowledge commitment needed on your part. But what you really have to do is do a lot of due diligence up front on the operators and who's going to be managing your money. So that could be a pro or a con depending on who you are and how your ability to really research these things and get to know these people. But you have a lot of control in that sense because you're not just putting your money out into the markets and hoping that takes care of things. You have control over who you invest with. But of course, that could be a risk if you don't do proper due diligence, if you don't really know who you're investing with, if you pull the trigger on somebody who maybe talks the talk but isn't able to walk the walk on the back end. So the biggest risk is going to be in the operator that you invest in. And that's where people need to focus a lot of their time doing a lot of their due diligence.
So what you're saying, Justin, is the biggest risk of a private lender investing in syndication is who's running the show.
Who's running it? Yeah, who's running it? And there's a lot of ways to mitigate risk, and markets are important, and asset types are important, and historical financials are important. But you really have to invest with somebody again who you believe in, who you begin to know, like, and trust. And don't invest with the first person you meet, even if they sound good and they're say all the right things. You want to follow them in their journey for a little bit of time. So really knowing who you're dealing with, who this person is, how's their company structured? Is it a big operation or a small operation? Neither is better or worse than the other. They're just different styles. What's the communication style going forward? Because unlike the stock markets, you should expect regular communication on the assets you invested in, how they're performing, what's the good, bad, and the ugly, what are some of the obstacles that we've overcome this month. So you're going to get a lot of those communications. You're going to be really married for the couple of years that the investment is in there. So really make sure that you're getting in bed with somebody you're comfortable with.
Well, that triggers a good question about how long is the private lender investing in a syndication and going to, more or less have their investment capital or their retirement funds, quote unquote, tied up to where they wouldn't have access to it.
Yeah, I would say most syndications are going to have about a 3 to 5 year timeline on them for some type of event, whether that's a refinance with cash being pulled out or a sale, depending on the business strategy. Now, there's different syndications. You can do shorter term ones that are quicker flips, or you can do, maybe a year and a half or 2 years. And a lot of your return is on that back end on that sale. Or you could have something that's more stable where they're saying, yeah, we're going to hold this thing for 15 years and refinance it every 5, but our cash flow is going to be this. And then when you get your money back from refinances, your returns will be this. So there's different strategies that you can explore a lot of if you want to do heavy cash flow for longer term plays, or if you want to do very quick transactional properties. There'll be operators that serve all of those niches.
Is now a good time to be for someone to consider investing in syndication, given the current climate? Well, first of all, how would you describe the current climate of real estate as far as, apartments and et cetera? And then the follow-up question to that would be, is now a good time or is now not a good time?
Yeah. The way I would describe the environment now is exciting. It's exciting to be an investor. What it's not exciting for are the people who have to exit their loans right now. That's going to propose some challenges. Luckily, we have had some safety measures with our properties that we won't be put in any of those tight spots, but some operators will. And because of that, it's exciting for the buyers. It's exciting for the people who are looking to continue to invest and who have long-term strategies in hold and long-term fail-safes with their business models of their investing. So I'm excited for this upcoming year or 2 years as a buyer, and we're able to hold off a lot of our sales to really wait for the markets to adjust. So is now a good time? I'm very, very excited about always being active in the investing space. Is now a good time? Yes, it is. Will you have as many opportunities come up as you did 1 to 2 years ago? Probably not, but that's a good thing. It's a good thing to have the deal flow kind of narrow down so you make sure you're still doing really good deals. So it's still an exciting time to invest. And just with real estate, just like anybody who invests in anything, they'll always tell you, well, I wish I started sooner. So it's always a good time. Your strategies just might change, and the amount of deals that you do will likely change, but you're always got to keep your eyes open for good deals.
Justin, I know we have got a lot of people listening that are interested in learning more about how they could do business with you or invest with you. They want to learn, well, what kind of returns can I get? Right? I mean, like right
Yeah.
now, we know it's pathetic in the local bank or credit union on the 12-month certificate of deposit yield.
Yeah.
Most people are looking to get a higher rate of return. So how can people get in contact with you and learn about the high rates of return and return on investment they can get by doing business with Justin Moy and his team?
Yeah, the absolute best place is going to be to download our free ebook. It's at thedefinitive.guidebook.com. It's called The Definitive Guide to Passive Real Estate Strategies. Should answer all of your questions about passive real estate investing and the strategies that are kind of within this niche. Discuss returns, discuss the steps into getting involved, getting started. And then throughout there, my contact information is all over the book. And you'll get some communication from me after that when the book is delivered on ways to get in touch with me as well. So it's thedefinitive.guidebook.com. That's going to be the absolute best resource for you.
Excellent. Well, there you have it, my friends. Download Justin's free book at www.thedefinitive.guidebook.com, and that will get you on the path to learning about being a passive investor. Justin, thank you so much for taking the time to join me on Raising Private Money.
Jay, this has been fantastic. Thank you so much. I appreciate everybody's time here as well.
You got it. Well, there you have it, my friend. Another amazing episode of Raising Private Money. I'm Jay Conner, your host, also known as the Private Money Authority, and I need your help. I really appreciate the shares and the likes. And if you are watching on YouTube by chance, be sure and click that bell so you don't miss out on our upcoming episodes of Raising Private Money. And if you happen to be listening on iTunes or Spotify, be sure and follow me. Look forward to having you join us here on the next episode of Raising Private Money. Here's to taking your business to the next level, and we'll see you right here on the next Raising Private Money.
Are you feeling inspired by the knowledge you gained in this episode? Then head over to jconner.com/moneyguide. That's jconner.com/moneyguide and download your free guide that shares 7 reasons why private money will skyrocket your real estate investing business right now. Again, that's jconner.com/moneyguide to get your free guide. We'll see you next time on Raising